Good morning, everyone. It's November 27th, 2015. Hopefully, everyone had a great Thanksgiving. Um, if you spend some time with families and friends, that really just makes it all worthwhile. And hopefully, you're thankful for what you have, as opposed to fixating on what you don't have. Oftentimes, and I've learned this through the years, I found myself fixating on the things I wanted and the things I didn't have, as opposed to being grateful for the things I had. And by sort of changing the way I saw life and again being appreciative for what I have, it really went a long ways in sort of helping me out through life in different aspects, and also of course help the person I was sort of helping out. So it goes both ways. It's a great holiday because it really sort of gives you a sort of a perspective of what life means and what really truly matters at the end of the day. In any case, in this week's video, I'll review the euro-dollar relationship, take a closer look at the TBT, or the Barclays 20-year Treasury note, and end by discussing some of the price targets some of the Wall Street firms have set for the markets for 2016 and beyond. So first things first. As always, I've included a few Fibonacci retracements that I think are important in truly assessing the current market conditions in the euro. It's pretty much a foregone conclusion at this point that the euro is going to hit parity with the dollar. Um, Goldman Sachs came out a couple days ago, or maybe yesterday, issuing their target for the euro. Basically, they stated that the euro could hit parity against the dollar as early as the end of the year, and hit 95 cents in 2016. Um, by me showing you what could potentially transpire in the euro, hopefully, if you're somebody that's been interested in trading the euro from the short side or trading long dollars, hopefully this will give you a better sense as to what levels to watch for, and again, sort of make you commit less mistakes, which is really what matters at the end of the day. But in any case, the two levels to watch for on the upside on the euro are 107.10 or thereabouts, and 108.48. These are two important levels on two different time frames. As you can see, 108 between 108.48 and 108.67, there are two important, or one's a fib extension and the other's a fib retracement from this range. And then at 107.01 and 107.13, there's also a point of commonality. And again, this is shown on the bigger time frame, on one of the fib extensions, and on this shorter dated fib retracement. So to the upside, the levels you want to watch for are 107.13 and 108.68. If 108.68 gets taken out to the upside, you have to be cautious and not get overly bearish to euro, because even though the euro may hit parity against the dollar, it's no guarantee that euro can trade appreciably higher first before it hits parity. Now, I'm not insinuating again or predicting that this is going to happen, but I've seen it time and time again where even though it's pretty much a foregone conclusion where a trade may go, the market will find a way to essentially stop you out, test your patience and really commitment, which is a theme we've seen all year long in the equity markets. The market will test your commitment and more often not make you or lead you to make a mistake, which is where again losses are made. So on the euro, the only way I would short the euro, or the ideal trade on the euro right now, is if you get a trade above 107.68, maybe as high as 108.68. Tag that price level, or maybe even exceed it temporarily, but then close back below 107.68. If that happens, that would be the again ideal sort of short setup on the euro for trade then to at least parity. You can trade it as low as 95 cents, or in my case, I would trade it down to 98 cents, which is where I would expect initial support to come in. If 107.68 and 108.68 do not get contested, then the next level you want to watch for are the current lows at around 104, 104.30, 104.40. That would be another ideal sort of short entry on the euro. Granted, if this happens, in other words, if the euro proceeds to take out the current low within the next few days or weeks, then you're not going to get that meaningful decline um, down to a dollar, or in other words, the momentum of the trade, the speed of the trade is not going to be, it's not going to be there. Of course, this goes against what Goldman Sachs is predicting, which is the euro is going to hit parity against the dollar by year end. I mean, I'm no one to say, the euro could possibly trade down to parity against the dollar by year end, but the way I see it, just from the part, based on the charts alone, I don't see that sort of speed on the eventual break of the current lows in the euro. It will get there, but again, you'll probably see more of a coordinated move down to parity. Maybe we get a break below 106.77, which is the other level I'm watching for. Maybe that could trigger a sort of swoon effect down to parity and as low as 99 cents, 98 cents, as some of these stops get get executed. But in any case, those are two ideal setups, short setups that is, on the euro. Again, a trade above 107.68, trading as high as 108.68 with a close back below 107.68. On that trade, you will target parity against the dollar. And if you get a break below the current 52-week low, then you could get a push certainly by the first quarter of 2016 down to parity. But I expect the speed of the trade to be different. So basically, that's really what I'm watching on the euro. I've said it time and time again. If you're someone who is new or doesn't feel comfortable with the leverage that the forex market offers, the best alternative is to buy an index or an ETF that tracks the price performance or the inverse price performance in this case of the euro. The EUO is a good example. It's a good proxy, again, that tracks the sort of the inverse relationship of the euro. So you could just buy the ETF outright, or you can go into the options market and sort of manage your trade from there as well. So those are two options you can trade around if you're not comfortable trading the FX market. As for the TBT, I mentioned how this already formed head and shoulders formation on the daily time frame is still very valid. You know, the neckline is priced on the TBT at 42.42. The only way we would see rates move lower or substantially lower in the U.S. is if this neckline gets taken out in fairly short order. With so much expectation already being built into the December meeting, Fed meeting, the possibility that a TBT breaks below this neckline before the December meeting is very low. Nevertheless, it doesn't mean price cannot retest this rising trend line, which remains in effect since we saw the yields make a low in early 2015. With that said, the only way you could possibly trade some upside on yields, or you're looking at the other way, a decline in bond prices, is if 148 on the TBT or thereabouts gets taken out on fairly short order and on high volume. If that happens, you get at least 6 to 7 points in upside, meaning you could target, TBT could trade up as high as 54 to 55 sometime in 2016. So if you're somebody that thinks yields are going to appreciate not substantially, but methodically in 2016, then perhaps going along the TBT on a trade above 48 gets you, again, 5-7 points to the upside. So that's another trade you could possibly look to take into, again, if you're bullish yields, bearish bond prices. As far as charts, that's really all I'm going to discuss. As most of you know, this was a shortened week. It was a week where not much happened. Volume was, or is, relatively low. The reason I decided to make the weekly video in advance is because the market today being Friday and being a short trading session, I just don't expect much movement either way. So it didn't really affect if I made the weekly video right now as opposed to making it on Sunday. And finally, I wanted to wrap up this week's video by sort of sharing with you some of the price targets some of the firms in Wall Street have set for the S&P 500. It doesn't matter where the bank, the consensus for most Wall Street firms is that the S&P is essentially going to end at current prices. In other words, the S&P is going to end the year at 2,100 or slightly above at 2,200. Just this morning, BMO Capital cited their year-end target for the S&P 500 of 2100. This coincides with Goldman's forecast of 2100 in the S&P by year end, and it's fairly close to what other firms such as RBC Capital Markets expect. They expected 2300 price target in the S&P 500 by the end of 2016. Barclays and B of A expect a $2,200 target in the S&P for the next 12 months. So as you can see, there's not much variability. Most of the reasons these firms cite is weakening demand and growth in Europe and China, rising rates being as the main culprit for impairing future returns in equity markets, at least in 2016. Trouble in emerging markets as far as their individual economies and the debt some of these countries holds that are priced in dollars. If interest rates are set to move higher in the United States, that with it will bring about a stronger dollar. Doesn't mean the dollar is going to rally necessarily. It just means the dollar is going to remain strong, and that's going to put pressure again on some of these countries and companies that took on dollar denominated debt a few years ago, thinking that the dollar was going to remain range bound in a fairly consistent band, being be it between 3 to 8%, looking out 10 years out. So that's certainly weighing on their sort of not negative but less enthusiastic and positive sort of view of the markets. With that said, firms like B of A and Barclays uh, and even BMO Capital expect the S&P to do fairly well, shortly thereafter. In other words, after 2016, they expect the current bull market to extend its rally, and some of these firms expect anywhere between 6 to 10% annual returns every year thereout through 2022, and some firms even go as far as 2025. B of A issued a price target in the S&P 500 3500. Whether that's true, gets realized or not, it's very hard for me to say right now. But again, I'm just simply citing some of the reasons they use to sort of come up with their price forecast. Personally, it makes sense if the S&P were to have another range bound year like we had in 2015, where again it's characterized largely by a lack of commitment of capital commitment and a lack of conviction by investors. And all that really changes and sort of molds the investors' attitude and how they approach markets. So at the beginning of the year, say into the first quarter, most of these investors, whether you're experienced or new, see that the markets remain range bound. That's going to affect sort of their psyche, and they're going to go again be much more prudent in how they approach the markets. In other words, they're not going to chase up price or pay a higher multiple, which is it's one of the prerequisites needed to really push markets higher. So it's certainly, and again, if you take it into context, as far as the S&P, how far the S&P has traveled since placing the generational low in March 2009, another year of consolidation makes a great deal of sense given the extent of the rally. So with that said, these reviews are there to sort of give you an idea of what bigger firms are sort of relying on or using to trade next year. I wouldn't necessarily sort of say the S&P if you trust a firm, I don't know, like Morgan Stanley, and think that their $2,200 price target, right? And this is just make believe. It's true. Then you can trade around it. You don't necessarily have to just decide to remain on the sidelines because of a lack of opportunity. There will be on a week to week and most certainly on a day to day basis opportunity. You just have to look much closer. And if you were to ask me what sectors would I want to focus on, technically in a rising rate environment, materials and energy do well, but with so much supply as far as crude oil, it's very hard for some of these soft commodities to rally. Hard commodities, I think, are going to have a better year than soft commodities. When we're talking about coal, iron ore, metal, they should have a slightly better year in 2016. But in any case, even if energy and materials do outperform the S&P 500 next year, it won't be by a big margin. Just keep that in mind. At least that's the way I'm viewing things right now. Really, the biggest beneficiaries are going to be global banks, or financial and insurance companies. There's a whole host of reasons why this is, but again, the sort of the proverbial thinking is that with higher interest rates, some of these banks are able to post higher profit margins, which again boosts earnings per share, and that really sort of feeds into price itself. So financials, materials, and energy, alongside with some insurance companies, are the sectors I would focus in on. Tech is also a valid option, but I think most of that money was made this year on the tech end. So again, those are some of the thoughts I have about the market. Hopefully, this video helped you. Next week and the week of the December meeting, I think, are going to be the two most important weeks of the year, or left in the year rather. So next week, I think it's fairly important, and then again, the week when the Fed meets are the 2 weeks I'll be keeping close tabs on. Other than that, hopefully we'll get a resolution either way. If we don't, we'll try to assess market conditions as they are. So enjoy the rest of your weekend. Stay small, stay nimble. Again, do not trust markets, but respect price for what it is. Have a great weekend.